Welcome to today's auto webinar series, Year-End Review, with, with Mike Curry and Ann Tourneau, who are directors at Citron Cooperman. If there are any questions, please put it in the Q&A box, and we will answer at the end of the discussion. Mike, would you like to begin?
Sure. Hello, everybody. Welcome to the seminar. So we're going to be talking about year-end planning, tax tips, and tax planning for auto dealerships today. And starting on page 4 with the tax tips. First item is the demos. So in the dealerships, you know that you give demos out to some of your employees, your key employees. And what should happen with these demos, the value of the personal use vehicle should be added to their W-2. What we do is we use the annual lease valuation tables to determine that. And you want to get the fair market value of the vehicle, find the annual lease value, and multiply that by the business miles over the total miles to get a percentage of the value that should be added to their W-2 and taxed accordingly. For 401k, it's kind of self-explanatory. The contributions and any loan repayments withheld from the employees should be paid into the plan, basically the same day as the payroll or shortly thereafter. W-4s, the W-4s should be updated by your employees once a year. The W-4 used to be a very simple form to fill out. It's not so simple anymore. There's a whole bunch of different sections of the W-4, and it gets a little confusing for the employees, but they need to fill that out once a year if possible, along with the I-9, okay, for the employee status verification purposes. Third-party sick pay, make sure that your office managers are aware that if there's any third-party sick pay with disability, there's disability wages. They went out on disability, and they get a quarterly report throughout the year that should be incorporated with your payroll company so that they can include them and incorporate them on their W-2s and W-3s and year-end 941s. A lot of times, the payroll company is pretty quick to finish your W-2s and W-3, and then this report from the third party, from the insurance company for the sick pay comes in later, and they got to amend. So if you know that you have that sitting out there, try to get a handle on that. Tell your payroll company that you have this coming, to wait and don't finish until you get the third party sick pay report so they can incorporate it with the rest of the payroll. Health insurance premiums. So premiums paid on behalf of a shareholder who owns more than 2% of the corporation are taxable as wages and are reported on the Form W-2. For limited liability companies, these premiums are considered guaranteed payments. The health insurance premiums, they're subject to federal and state withholding tax, but they're not subject to FICA or Medicare or unemployment tax. Same thing with self-employed retirement benefits. These are usually left in the P&L section. They should be considered guaranteed payments similar to the health insurance premiums. So now you have potential sales tax issues. You have to file your sales tax returns accordingly. If you have any out-of-state sales for parts through your parts department, and they sell parts over the internet or telephone and ship them out of state, you have to keep track of the sales volume, the sales that are that you generate from out-of-state sales, and pay the sales tax accordingly to those states. The Affordable Care Act, your insurance provider should provide all your employees with the 1095 at the end of the year and make sure they're in compliance with the Affordable Care Act. Travel and meal expenses. The travel expenses are deductible in full. Certain meals are limited, and certain expenses for holiday parties for the benefit of the employees, promotions, on-site employee meals, they're not limited and should be posted to separate accounts. So you want to keep a separate account for meals that are limited and meals that are fully deductible. Entertainment expenses, so for incurred for amusement, recreation, membership dues, they're no longer deductible, and these should be posted to separate accounts since they are not deductible, and we can isolate them at the end of the year and record them accordingly for tax purposes. Employee fringe benefits, including transportation, on-site gyms paid for by the employers, are no longer deductible, and they should be posted to separate accounts as well. Section
Tanisha,
1,
next page, please.
Section 163J. So Section 163J limits, in certain circumstances, can limit the deductibility of your interest expense. Your floor plan interest is not susceptible to the limitation. So we want the office managers to always separate your floor plan interest expense from the other interest expense that you have based on your cap loans to individuals, intercompany loans. And, the floor plan assistance that you get from your floor plan should not be merged with your floor plan interest expense. It should be separated in other income. So your floor plan interest should stay by itself. So we could see that. So when we prepare the return, there's a form that we have to prepare that separates and allows this deduction in full, and would only possibly limit your other interest expense based on cap loans and mortgages and things like that. Section 199A. So this is where you get a 20% deduction on your net income. And we determine that after, making our adjustments at the end of the year. And also your realty companies that are self-rental associated with the dealerships. Now, if you have reinsurance income that are reinsurance rebates separate from the dividends that you received, there's certain reinsurance income that you should probably have the 1099 issued to the dealership under the dealership name, a number, ID number, so that that could be susceptible to the 20% deduction as well. So you might want to look into that, make sure that it's not going to on a 1099 to you personally, the dealer owner. Okay, so if you can move it to the 1099 to the ID number of the dealership for certain amounts of income, certain types of income, that would be beneficial. 1099s this year, you want to get your list of 1099s to us as quickly as possible in January, as early in January as you can. You now have a new 1099 form, 1099 NEC, where it always was a 1099 miscellaneous. So the 1099 NEC is for payments to unincorporated entities, individuals for $600 or more. And those 1099s are, it's usually in box 7 that you're used that we see, that it's for non-employee compensation, and they're now due by February 1st. All other items of income can go on a 1099 miscellaneous, and the other items of income reported on that 1099 is due by March 1st. And I think we have to file a state copy as well. Form 8300s, the dealership has to provide a written notice by January 31st on an annual basis to any person whom the dealership received $10,000 or more in cash payments. This is due to each person by February 1st. And during the year, you should be complying with the requirements to file the 8300, because there are major penalties if you're not compliant in finding those deals where there's cash payments of $10,000 or more. Okay, the fines are significant. So you want to make sure that you're complying with the 8300s. For New York dealerships, you have the Metropolitan Commuter Tax. So in those boroughs that you see, the Metropolitan Commuter Tax is due for payrolls over a certain amount on a quarterly basis, and it's uncovered employees' wages regardless of where they reside. All New York City employers with more than 20 employees must provide pre-tax transit fringe benefits. And for your commercial rent tax, if you're in the city of Manhattan, in the borough of Manhattan, south of the center line of 96th Street, and your annualized gross rent paid is at least $200,000, you have a quarterly rent tax that's required to be paid and filed. Okay. Payroll tax deferral.
Could you flip the page, Tanisha? Thank you.
Okay, so under the CARES Act, the employers and employees, they had the option of deferring the Social Security tax. So for the employer's portion of the Social Security tax, you can defer. You were able to defer if you took advantage of this. Most dealerships that I know did not take advantage of this because they just have to pay it later. So if you deferred it from March 27th to December 31st, you have the option of paying it back over the next 2 years, 50% each year. If you do that, you can't take the deduction for the employer's portion of the Social Security tax unless you can pay it by the due date of the return, or by the due date of the return with extension. Okay, within the next year. If you know you're gonna pay the tax off by then you can deduct it on 2020. For the employees, if the employees deferred their Social Security tax from September 1st to December 31st, then the employer will then have to ratably withhold the deferred amount from the employee's paycheck from January 1st to April 20th of 2021. So if you've done all that, you have to be aware that this is how you have to handle the deferral of the Social Security tax for the employer and employee's portion. Okay, so the PPP loan, everybody's favorite topic. We would like you to compile all the necessary documents required, payroll registers, invoices for covered expenses, lease agreements for the PPP loan forgiveness application. We need a copy of that application so that we can see what your expenses are that you're trying to get forgiven. And you are required basically to pick up the income, if it's reasonably expected to get forgiveness in 2020. We have to allocate those expenses and reduce the wages, the rent, the mortgage interest. I'm forgetting one right now, proratably. And then if your forgiveness application goes through in 2021 and say some of it's not forgiven, you would have to, then you can deduct those expenses according to the percentage that was not forgiven. You can either do it in 2021 or you go back and amend your 2020 return. New Jersey is allowing the expenses. Okay, so if you're in New York, Connecticut, you have to disallow those expenses. In other states, New Jersey is allowing those expenses to be deducted. So you're not picking up the income and you're getting the benefit of the deduction in New Jersey. Okay, so debt refinance, if you have debt on the books and with interest rates so low, it's probably a really good time to consider uh, refinancing. With interest rates so low, they're probably going to be low for a while, but you want to take advantage of it and just review what you have on the books right now and your loan agreements and take a look at that more closely and consider refinancing. Any quarterly estimates that you have, make sure that your federal, state, and local estimates are being paid and being paid timely. And now New Jersey just came out with the pass-through business alternative income tax act or business entity tax, where you can deduct the tax, so to speak, your tax on the net income of the on the net income of your entity, of your dealership and your other entities, based on what you project the net income is going to be for the year. You get a deduction against your federal taxable income, which is the really good thing about this. And that tax will be withheld, will pass through to you on a K-1 to the individual shareholders and partners. And then you get to take a credit on your New Jersey income tax return for those taxes. Most likely you'll be overpaid and you'll get it back as a refund on your New Jersey income tax return, because the tax is going to be based on a full year's worth of income. And going into 2021, it'll most likely be paid out ratably over the 4 quarters. But right now you have to pay, if you choose to, it's an option. You don't have to do it this way, but you can pay the full year's tax and get a deduction and just from your federal taxable income, like I said, and just get it back on your New Jersey return as a credit. So that's a really nice thing right now that you could do. And that takes me to the end of the tax tips. And now Ann Torno is going to talk about transactions and calculations that you should be looking at for year-end planning for your tax return, which is due sometime next year. So take it away, Ann.
Everybody, I will be walking you through the year-end closing. So let us begin. Cash. Prepare your bank reconciliations. Make sure that you do this for all of your accounts. And after all the bank recs have been prepared, you should be reviewing the reconciling items for any possible adjustments. You should also be looking at your outstanding items and consider start thinking about unclaimed properties for any age outstanding items. With regards to your cash clearing accounts, make sure that the balances on these accounts are reasonable. Typically, the balance are small, so make sure you're looking at these balance and that clearing that they are clearing the first few days of January. With regards to your accounts receivable, you should be looking at all of the AR schedules, your trade, your swap, your employee receivable, your manufacturer receivable, your service and parts. For any look out for any credit balances that you have or any age items that you see on the schedules. So for credit balances, you want to just make sure that those balances do not need to be or do not need to be picked up into income, or whether it's a true liability. If it's a true if it resulted into from your research that is a true liability, then consider reclassing those to a liability accounts rather than sitting in the AR balances. For age item, you want to make sure that the claims don't need to be resubmitted. As you go through that exercise, if you see that it is a pattern, you should be dedicating a resource from your office to make sure that the claims are submitted timely, or that additional requests from the manufacturer are addressed timely. You don't want those balances to be aging, even though some manufacturers allows you to resubmit some claims, a year after. You also want to check for large outstanding items such as manufacturer receivables if they have been outstanding beyond the normal terms. So for example, if you know that your manufacturer usually pays on a monthly basis on incentives that you earned, and you have balances outstanding since September, those balances should definitely be reviewed. Um, so go through all those examples that I've mentioned. And if there needs to be adjustments such as write-off of uncollectible balance after your research and proper authorization, go ahead and propose those entries for your either your 12-month statement or your 13th month statement if you have it. Next page, please. Your prepaid accounts. So typically this account or these accounts are a dumping ground of various transactions. We see a lot of construction in progress in these accounts, or end of month entries, for example. So you want to make sure you review the balances, each control number, and determine if there needs to be a reclassification entry or a write-off or a pickup for that matter. The remaining balances should truly be the portion that's related to the subsequent period. So you should definitely start to recalculate your prepayments and adjust the balances accordingly. Um, our next topic is fixed assets, which is a big asset item on your balance sheet. So first off, I think you should be reviewing your asset listing for any disposal or any assets that you abandoned. Um, you should definitely um, revisit that list periodically, more often than yearly. You should definitely have a written policy on your capitalization. The IRS has a de minimis safe harbor rule where you can expense any purchase of 2,500 per item. And if you have audited financial statement, the threshold is $5,000. You also want to make sure you go through your general ledger and determine if there are any repairs that are included in there, or any purchases that falls within that de minimis safe harbor rule, um, whereby you can expense those items. With regards to improvements and repairs, repairs are typically you're painting, or you're fixing something, or you're placing a portion of something that was broken. For example, like a tile, a floor tile, or a broken pipe. An improvement is renovating the whole entire room, the whole entire system, like an HVAC. So those are the difference between those two. A repair is an expense, and an improvement, according to your capitalization policy, should be capitalized. Um, and also 100% write-off, either with Section 179 or bonus depreciation, could be available to you depending on your situation. Um, next thing is something that we see all the time is the classification of company vehicles versus service units. So we see a lot of, when we do our visit, we see a lot of dealerships that commingle these assets. So company vehicles are your loaners and your demos that are subject to your monthly write-downs. But your service units are your plow trucks, your van, your parts van, that should not be written down, because those assets are used in your operations. So therefore, they will be depreciated. and not, again, not written down. So you want to make sure that you take that into account when you are classifying your company vehicles versus your service units. If you have mistakenly written down service units in throughout the year, um, you should be reviewing that and consider reversing those as on your 13th month or your 12-month financial statement. Also, something to look out for is sometimes vendors don't charge sales tax, or they charge a different sales tax, to make sure that the proper sales tax is charged to your purchase. If not, then you can just basically do a catch up on your next sales tax filing. Next page, please. Oh, okay. Finance reserves. So we do recommend that you always reconcile these on a monthly basis, and you record your chargeback and your differences every month as you reconcile the finance reserves. Rental units, if you have them, you should definitely review the valuation of your rental units. Rental units could be written down to its market value, its fair value. So you want to make sure that your rental units are written down and reviewed every month for if there needs to be an adjustment to bring it to market value. Typically, what we see is your rental units and the payable associated with the rental units um, are zero, or that the net value on the balance sheet of the rental units equates or close to at least the liability, which is typically the payoff amount. Um, with the floor plan, you, again, best practice is to reconcile the floor plan statement to the GL monthly, and you also review the reconciling items after you have performed the floor plan reconciliation. Your reconciling items are typically your just timing issue, and that those should clear subsequent to the month end. Um, Also make sure that your December interest is accrued, as well as admin charges such as insurance and other fees are accrued and included in your trial balance. Your debt, you want to make sure you get a statement at year end and adjust the principal balance accordingly. Sometimes we see that, you know, the interest portion is reducing the principal payment. So that's your time to catch up and true up the balance of your debt, as well as classify the debt balance accordingly between short-term and long-term portion. Short-term portion is typically your balance, the part of your debt that's due within 1 year, and then the balance sits in um, long-term portion. That's very important because that also affects the calculation of your working capital. So make sure that's also done on a more regular basis other than year end. Um, you also want to make sure that the interest related to the period is accrued. So if you haven't expensed December and you pay the interest in January, you should definitely have an accrued interest for that particular loan. Next page, please. Okay, now we get into inventory. Inventory is probably your biggest asset on your balance sheet. So we want to make sure you understand what needs to happen for year end. So for parts, if you haven't done so, you should be scheduling your parts physical. Although with this COVID environment, we have seen less and less of the parts physical taken. Um, that doesn't mean that you shouldn't be looking at your physical. At least monthly, you should be reconciling your pad to GL and review those reconciling items for possible adjustments. You should also have your parts manager review the inventory for any slow moving or damaged parts. Consider returning what you could to the manufacturer and identify, have him assist you identifying any adjustment. For example, again, slow moving or damaged parts, obsolete inventory, um, those things that you can um, quantify and adjust the balances for. With your new vehicles, in order to prepare for the LIFO, um, we have what's called a what if adjustment. By now, I believe you probably already have that number. So you should be recording an adjustment on your 12-month statement, and then start gathering the manufacturer invoices for inventory you have on hand in preparation for the actual LIFO calculation for year end. We know that it's a tedious task. So, we want to get a head start on that and preparing for that huge task at year end. For new cars, if you have um, if the 2021 models are out, you can and you still have 2019 models in inventory, you can definitely look at those and see what the wholesale values are for the 2019 models, and you can review that for possible new car write down adjustment, as long as the value that you're using is the wholesale value for those vehicles. So that could be a possible tax adjustment at year end. Now, for used car write down, um, you typically do the same thing. You look at all your inventory all the vehicles that are sitting in your inventory at year end. Then what you want to do is compare that to the wholesale value at year end. But remember, if you do pack your car, you have to use the original costs rather than the packed amount, um, in coming up with the used car write down adjustment. Next thing is our FPA, our floor plan assistance adjustment. So if you've never deferred floor plan assistance on your tax return, you'll just need to file a form with the IRS stating so, and then you can start adopting this practice. So what the IRS practically lets you do is defer the income, right? So typically we see floor plan assistance being picked up into income as the vehicles are stocked in. So what the IRS allows you to do is to defer that income until the vehicle are sold. So you're on year one, you may have a significant adjustment depending on your new vehicle inventory. Um, but for the subsequent years, the impact to the profit and loss will just be the relative FPA, and the swing of the inventory, the new vehicle inventory balance. So if you have increased your inventory, your new inventory, it will most likely result into a write-off, and vice versa. The IRS also lets you do this similar treatment for any other manufacturer incentive that you receive, um, that could be tied to the specific VIN. For example, Honda has Honda Transfer Balance. Those could also be treated similarly. Now, going back to the new car, used car, and FPA, again, they need to be by vehicle. The analysis needs to be by vehicle, not a blanket. If you're looking at used car write down, you can't just take 10% and apply it all the way down on each of your inventory. They need to be the wholesale value and its cost needs to be looked at on a VIN vehicle by vehicle. The same thing with FPA and any other manufacturer incentives that you are deferring. Um, with WIP might be such a small amount, but you should definitely reconcile those. We understand that it's not a significant balance, but definitely review that every period, and that um, you should review if there's any difference that arises from that reconciliation. Um, for the our UNICAP, Uniform Capitalization Adjustment, sometimes you hear us talking about, UNICAP or 263A. So what you need to start doing is gathering the wages of the personnel that are responsible for handling, managing, or storing inventory. For example, your parts inventory manager, your drivers, your general managers, new car manager, used car manager. Um, and want to remind everybody that it's just the base salaries. So you should not include any bonuses or commissions that they've earned. Next page, please. Okay. So on your with regards to your accounts payable, you want to make sure that that is kept as long as you could, so you can include all the invoices that you receive. For invoices that you have not received and you know that you have those expenses, you should accrue those expenses accordingly. So you look at your bonuses, your employee benefits, advertising, rent that hasn't been paid, any chargeback, any lawsuits that you know that you need to settle, um, and so forth. You also want to make sure you reconcile your open part statement to the GL monthly. Again, the reconciling items should only be typically are timing differences, so those should clear by few days after the month end. Um, your taxes, make sure you have a log of what's been paid. We'll need those to prepare the tax return and claim those payments in there. And as Mike alluded to earlier, with regards to non-floor plan interest, you want to make sure those expenses are segregated from your floor plan interest expense. And this is because of we have to go through the calculation for the 163J limitation. Your non-floor plan interest may or may not be deductible for this year. So it's important that those two expenses are segregated: floor plan interest versus non-floor plan interest. You also need to look at your posting of the manufacturer, the FPA that you receive from the manufacturer, and make sure the credits are sitting on a separate account, not included in the floor plan interest expense account. So that's also very, very important. Um, with regards to your reinsurance, you want to make sure that you account for all the expenses and and payments, and that those have been received by the admin. Um, and if you haven't paid December, that should definitely be part of your accrual. Um, if you have shareholder loans on the books, you want to make sure that the balances um, are correct, and that the interest on those loans are calculated and paid by year end. You always need to pay close attention if your entity is an S corporation, because your contributions and your distributions need to be according to the ownership interest. Um, so definitely watch out for that. On the LLCs, although it's not required, it is also recommended to have the distributions and contributions the same as the interest, as the members' interest. And with that, we could take any questions or comments from the audience.
from the guest?
And and this is Will Fernandez. I want to thank you and Michael for really putting this together, and also working on the document itself. I know you guys started working on this early on this fall and produced the document. It's out there. My understanding is that document is available at our website. So if anyone wants a copy of that document, it can go right to our website and get a copy of the document with all the procedures, the tax tips and the accounting tips. And I just want to thank both of you for what you did. There's been some questions that have come up, and there was and Michael, there's a question that came up. You mentioned that fixed assets, you're allowed to take bonus depreciation, but is there any limitation on bonus depreciation based on the 163J limits? I think Ann, you're on mute if you're answering the question.
Hi, can you hear me?
Now I can hear you now.
Okay.
Yeah.
So your question is limitation on the bonus depreciation.
Correct.
Okay. So bonus depreciation is 100% write-off of your fixed asset addition, including qualified leasehold improvements. On the dealership side, because the Congress allowed the dealership to take 100% write-off on the floor plan interest. The other side to that was previously they were not allowed to take advantage of the bonus depreciation, but you can do a test every year. You can subject your floor plan interest into the 163J limitation, and if you pass that test, you are able to take you're able to take advantage of the bonus depreciation.
Well, that's a good point, because this year, with PPP included in the income and profitability in a lot of dealerships up, they may have that opportunity. So something not to oversee. Ellen, do you want to come in and help out with? I think there's another question. Maybe you can bring that up to the group.
And unmute challenged. Hi, everybody. I lost my questions. I wrote down a whole bunch of questions. Wait, I found them. So we've heard a lot of stuff today. And one of the questions that I always get is, how do we treat the PPE loan for year end? So Michael, do you want to just tell everybody just in a brief how to get everything together we need? Because what people don't understand, it's not deductible. There's certain limits, certain time frames. There's so many different things that I think a lot of people might not understand. So Mikey, will you take it away and just give it a brief, what we need and what's not deductible, etc. Please.
If you reasonably, oh, can you hear me?
We want to see you.
If you reasonably expect to get forgiveness, you need to pick, you're picking up the income in 2020. Okay. A lot of people haven't filed their application yet for forgiveness, so they need to put that together. And I mean, by the time the return, if we get into February and March, hopefully they all have that together. And we have to reduce the expenses accordingly. So if in 2021, I mean, we need that application so we could see all those expenses and how, what you've submitted. So in 2021, if the forgiveness application goes in, you find out that you do not get forgiveness in 100%, then you're going to have to take those expenses and whatever percentage it is and deduct it accordingly in 2021, or go back and amend 2020. If you expect that if you're not going to submit the application for forgiveness, then I think you could deduct the expenses in 2020. If you don't even want to file the forgiveness application, I don't know why you wouldn't, but so you can deduct the expenses only under in that circumstance.
Hey, Mike, I think, yeah, that's, thank you for the point you raised. I think what's going to happen, though, is for federal purposes, each state is different, so you have to go back to your states. But for federal purposes, the federal government's basically taking the position that regardless of when you file for your application and when you get your SBA approval letter, they want to see the taxation numbers in 2020. They're basically taking the position is, it's your timing to file for forgiveness. So just be aware that the tax impact is going to be in 2020. If you apply in 2021, as Michael said, and find out there's an adjustment, you can go back to your 2020 return. If you haven't filed it yet, correct it, or go back and amend it for any adjustments that the SBA may say. So if you had a $100,000 loan and they only forgave 90, then the $10,000 adjustment you can pick up and go back and amend it to 2020. So there is a possibility that Congress may pass a law that allows the deductions between now and the end of the year, but I wouldn't hold anybody's breath on that because they've been promising to do that for the last 6 months. So so I think we're close to time. Is Tanisha, are we?
We're a little over time, but there was one other thing that I wanted people to prepare. You've all heard of cost cap and 263A. Since we've already touched on fixed assets, there are items that you need to get together for your accountants for the 263A. So I'm going to throw this to, I know we've heard a lot of stuff today, so feel free to call Will or Mike or Ann or myself for clarification on anything. But I just want to throw this to Ann or to Mike about cost cap and what you need to just have on hand for your accountants so that they can calculate it, because it is just a tax entry for you. It's not an operating expense or anything. So Mike and somebody want to tell?
Sure, I can take that.
Okay.
So in order to prepare for that adjustment, you want to start gathering payroll information for the personnel that is either in charge of storing, handling, or monitoring inventory. And wages is their base salary, not including bonus or or commissions. So you want to start gathering that information if you have it or if you don't have it yet.
We also ask for outside storage if they store cars in a different location. We usually include that in our calculation as well. So outside storage would be another item that we look at that we would need to know.
The whole idea about cost cap is that the IRS says you really can't expense anything having to do with assets like inventory, specifically for inventory. So even though you have all these expenses that might go detailing or this or that, everything has to be capitalized and they don't want you to take any expenses. So that's why they make you do this calculation. So help your accountants out and get all this stuff together. And we are very late, so so it's not to keep anybody too much longer. Mike and Ann, you did a fabulous job. And Will, you always do a lovely job.
Thank you.
Thank you all for.
Thank you.
Thank you, everybody, for joining in. Thank you for
Be
joining in.
safe.
Take care.